Hey guys, welcome to another Trade Genius podcast. Bob and Phil here. As always, we got a good one for you because Bob's uncovered another chart showing you how dire the situation is with the government and our inability to pay back our debt. So you're not going to want to miss this episode. Let's dive in.
Trade Genius.
Hey guys, I'm gonna tell you something that we do that really will change the way in which you look at trading and also absolutely help you increase your profitability and how much money you make. It's the Trade Genius newsletter. We put the newsletter out Sunday night through Thursday night, and this really looks at the plumbing of the markets and helps prepare you for the next trading day and help you make money. And we give you a lot of information. We give you market statistics, we give you market levels, we give you the seasonality, what's happening with different sectors of the market, and we will help you identify whether the market's in a bear mode or a bull mode, or whether it's euphoric, whether it's despondent, and it just puts you in a position to be on the right side of the trade. So take advantage of our offer that we have below, and you'll love it. I mean, one trade that you make with this thing can pay for definitely a month, maybe even a year's worth of service. It's that powerful. Use promo code podcast for 15% off the retail price of newsletter. Thanks for listening.
Hey Bob, your market's been gyrating up and down since CPI. Really hasn't gone anywhere on net, and I think we're just kind of floating into OPEX. But in the meantime, looking at kind of more macro things as to where we might be headed after OPEX, I think you found some interesting data points on the tax situation, for one, in this government.
Yeah, I mean, look, welcome to the deadbeat nation. Everybody's wondering when Powell's going to have to pivot. And I guess, maybe we should title this thing, We're Really Turning Japanese, is that they're going to have to YCC this, which means yield curve control, which means the Federal Reserve is going to have to come in and agree to buy debt at a much lower rate than the marketplace would normally allow them to do so. And the reason is, check out this chart, Phil. I mean, this should scare the bejesus out of you, okay? The interest expense is going straight up, but look at what the tax receipts are doing. Okay, normally if you're in an environment of growth, those tax receipts should be going up with the interest expense, with inflation, with everything, but it's not happening because two things are happening instead. People are retiring and they are on more of a tax-friendly, kind of compensation plan, number one. And number two, people aren't working and are getting a lot of transfer payments from the government. And this is just an absolute recipe for disaster. And, there's very few ways out of this. One is you got to ramp up productivity like mega. And we talked about this before, bring manufacturing back to the U.S., apply tariffs to imports, force people who aren't working to actually work, and bring down the cost of government to the extent you can. Or you create creative ways in which you push the financing requirements out past the baby boom bulge. And I hear none of those things. All I hear is the same old, staples that the Uniparty gives. But that's the only way we're going to get any hope of getting out of this. And it's a big problem. And, I'll kind of cede the floor to you and ask you to, what's your thoughts on this? Do you kind of see this as, hopeless, or do you see that there's an opportunity here somewhere?
No, I think it's insurmountable at this point, and unless they figure it out and get the spending under control, something's going to end up breaking. I mean, that aside, look at what's going on with that chart. I mean, every time that you've had a large disparity between tax interest expenses and tax receipts, meaning that line, the upper line, basically diverges away from the lower line, it's all recessions every single time. And this one is the most extreme form of divergence in percentage terms. So I don't know how we're not going to go into a recession, because tax receipts is basically a direct driver of economies, right? And so here we are at the lows of the range, basically. So it's another indication of recession. And I don't know how many we've shown in the last couple of weeks, but it's just too numerous at this point to count. So longer term, I don't know, without reining in the spending, which these politicians don't know how to do, I don't see how. You're right. At some point, I think we're going to have to fall back to yield curve control. And I just think the way that things are now, and everybody's looking for a handout, especially after COVID, I think you're getting more of the general population is looking for lawmakers that are into that sort of, socialism type of thing, where the handouts are going to be the quick solution. So if that's the case, case, you will force the central bank to become like Japan, to implement yield curve control. And what happens in that environment? Well, you just end up printing again. And so you're going to devalue the currency. So what you want is the hardest assets you can find. So Bitcoin, metals, some of those precious energy plays like plutonium or uranium, and I think real estate and things like that to a lesser extent. If you don't have those things, you're going to get smoked in terms of your buying power, and you might have money in the bank, but you're actually losing money. You're losing buying power. You're losing wealth, and that's I think that's the scary part of this whole thing. And why, if anyone watches our programs or joins our service, at least take away that you need to be in some hard assets going forward, because I do think like the yield curve control that you described is 100% inevitable at this point.
Yeah, and we're bearish macro, but we're not bearish stocks. I mean, Bitcoin seems to be sniffing out something here too. And you also have, and the reason why I'm big on energy, the same difference. Energy is the ultimate inflation hedge. And when they do yield curve control, then you're going to want to own, ironically, you're going to want to own long bonds. Okay. But if you own none of these things, I think your earlier solution, Phil, maybe people should just drink the plutonium because their life will be better if they're not around, because you'll literally be instant poverty if you don't own assets.
Yeah.
Okay. In this environment, if you notice too, they're talking hard landing, soft landing. All of a sudden in the lexicon, this word came out called no landing. Okay. And no landing means is that we're going to get this crack up kind of environment where nominally it looks like everything's growing, okay, because the inflation rate has took off. And that doesn't necessarily mean the stock market's going to rip. It's going to mean certain parts of the stock market are going to do extremely well, and certain parts are going to do extremely poorly. So the volatility is going to pick up, and it's going to become a more difficult market than just being a passive investor. So, but enough on that. I want to show you, if I could, Phil, if we could flip, because this whole thing has captivated me on these call buying and the zero TTE. And here, I want to just show people what has been happening over the last 6 weeks. We've had the biggest move, I would say the fastest move, but the second biggest move in call buying than we've had in the last 3 years. I mean, this is just absurd and insane. And the only reason why I bring this up is that this is not sustainable. And it's going to be one of those days, it's going to be an overnight event that you're going to wake up and your head's going to be handed to you because they overprice these options and then people start selling them versus buying them. And then it's going to be all over. And today, we received word that Carl Icahn looks like he's adding to his bet for March put contracts. And this guy, he's not doing a fade trade. He's actually putting money in because he thinks the market's going to go down and touch 39.50 in the next 6 weeks. And so we want you guys, he's the smartest trader out there, him and Druckenmiller. And both these guys, I would say, make you and I look bullish at this point. They're both pretty bearish guys. And these guys have a lot of money and they make the market. Phil and I, we follow the market because we have no hope of influencing it. And last time I checked, I wasn't God, so I don't know really what's going to happen tomorrow. But these guys are godlike in the sense that they actually make the market move in their direction. They can will it by just sheer size. And both these guys are looking for a pretty good correction here and soon. And that's why we've been kind of screaming from the rafters on this stuff. So that's the kind of stuff I wanted to get out, Phil. I don't know if you want to add anything to that comment.
No, I agree with you. Just pointing out that on that chart, if you look, I think the numbers on the right are in thousands of contracts, which means it's 2.5 million call contracts. And whenever this market gets above 2.5 million call contracts, those dates that you see that it did it around August of 2020, around January 2021, just before August 2021 into November 2021, which you all know is the top of the market. So what the point is that those are all high volatility areas. If you go back and look on the charts, so we're getting into that danger threshold of that as well. And when you're doing it in the way that they're doing it, much like the top of the market, that's where you get the big downdrafts like Bob's talking about, because it's really just high leverage. It's really no different than when FTX is giving you 100x leverage and everyone's just chasing that carrot up until they run out of roadway. And it's like Wile E. Coyote off the cliff, like that thumbnail we did the other day. It's the same thing. And so, the quicker these things jump up like this, the quicker the fall is. And we've shown you guys enough metrics. You know how much air is underneath this thing. So we're of the mind that we could levitate into OPEX, but really after OPEX, that's when you have to start looking at the seasonalities, and they all point to the last 2 weeks of February being rather bearish. And so you kind of add all that stuff up, and you have to be a little careful here. Even though we may stay up into Friday, it's after Friday we're really concerned about what happened. So that's what this is telling us.
Yeah, so we rather err on the side of caution. And, I'd rather you guys laugh at us that we missed the 5% move higher than you get on there and what happened with a 30% move down in 2 or 3 weeks. And those things are very possible when you're at these levels. So
Right.
Just be really careful out there. I mean, we're walking on quicksand in a landmine right now.
All right, cool. All right, well, thanks, Bob. And thank you guys for watching. Please hit like and subscribe and ring that notification bell. And again, if you guys are interested in that newsletter, check it out at tradegenius.co/newsletter. We'd love to have you as subscribers, and we'll see you on the next episode. Take care.
Trade Genius.